Have you ever wondered how to make money online with Forex trading using US30 and S&P 500 signals in a week? Welcome to the exciting world of Forex trading, a global marketplace where currencies are bought and sold. In the simplest terms, Forex trading is the act of buying one currency while simultaneously selling another. It revolves around the speculative trading of currency pairs, like the euro against the US dollar or the British pound against the Japanese yen. Now, what sets Forex trading apart is its sheer volume. It's the largest financial market in the world, with over $5 trillion traded daily. Yes, you heard that right, over $5 trillion. This high liquidity means that transactions can be completed quickly and easily, making it a highly attractive investment option for many. But how do we know when to buy or sell? That's where market signals come in. These are indicators or alerts that inform traders about potential opportunities in the market. They are generated by thorough analysis of market trends, economic indicators, and various chart patterns. In the realm of Forex trading, US30 and S&P 500 signals play an instrumental role. The US30 is an index that represents 30 of the largest and most influential companies in the United States. Similarly, the S&P 500 is a market capitalization weighted index of the 500 largest U.S. publicly traded companies. These signals provide valuable insights into the health of the U.S. economy, which in turn influences global currency values. Utilizing these signals can help traders make informed decisions about when to enter or exit a trade. They serve as a compass, guiding traders through the dynamic, often unpredictable landscape of the Forex market. So whether you are an experienced trader or a novice looking to dip your toes into the Forex waters, understanding the importance of these signals is paramount. They are not just numbers on a screen, but a reflection of the economic activities that drive the world. Now that we understand what Forex trading is and the role of US30 and S&P 500 signals, let's explore how we can use these signals to generate income online. You may be wondering, what exactly are the US30 and S&P 500 signals, and how do they work? Well, let's start with the basics. The US30 is a signal that represents the Dow Jones Industrial Average, a major stock market index in the United States. It's made up of 30 large publicly owned companies based in the United States, and it's often used as a barometer for the overall U.S. economy. On the other hand, the S&P 500 is a signal that represents the Standard & Poor's 500 index, which is a stock market index that includes 500 of the largest companies listed on the stock exchanges in the United States. It's considered one of the best representations of the U.S. stock market and a bellwether for the U.S. economy. Now, how are these signals calculated? These indices are calculated using a market capitalization weighted methodology. This means the size of the company is considered in the index. The larger the company, the more weight it holds in the index. But how do these signals help in predicting market trends? These signals are often used as indicators of the overall market trend. For instance, if the US30 or the S&P 500 is trending upwards, it can signal that the overall market is in an uptrend. Similarly, if these indices are moving downwards, it can indicate that the market is in a downtrend. But remember, these signals are just one piece of the puzzle. They should be used in conjunction with other market indicators and analysis tools to help you make more informed trading decisions. In essence, understanding the US30 and S&P 500 signals involves understanding the broader trends in the US economy and the stock market. By keeping an eye on these signals, you can gain a sense of the market's direction and momentum, which can be invaluable when making trading decisions. Knowing how these signals work will give you an edge in the Forex market. Next, we will discuss how to use these signals to trade. So, how can we use these US30 and S&P 500 signals to make money in Forex trading? This question brings us to the core of today's discussion. To answer this, let's delve into how you can interpret these signals and apply them in your Forex trading journey. First off, it's important to understand that these signals are essentially indicators of market trends in the US 30 and S&P 500 indices. Essentially, they provide a snapshot of the market's performance and direction. The US 30, also known as the Dow Jones Industrial Average, represents 30 of the largest publicly owned companies in the United States. On the other hand, the S&P 500 is a broader market index that includes 500 of the largest companies listed on the New York Stock Exchange, or NASDAQ. These indices are barometers of the U.S. economy, and their performance can have a direct impact on the Forex market. For instance, a strong performing US30 or S&P 500 often indicates a strong U.S. economy, which may lead to a stronger U.S. dollar. This, in turn, can influence currency pairs involving the U.S. dollar. Now let's walk through a step-by-step guide on how to use these signals in your Forex trading. First, monitor the US30 and S&P 500 indices. There are numerous online platforms and financial news outlets that provide real-time updates on these indices. Next, you need to interpret these signals. If you see a rising trend in the US30 or S&P 500, it could indicate a strengthening US economy and potentially a stronger US dollar. On the flip side, a falling trend could suggest a weakening economy and a weaker US dollar. Now comes the crucial part, applying these signals. If the signals suggest a strong US dollar, you might consider buying currency pairs that include the US dollar as the base currency. Conversely, if the signals suggest a weak US dollar, you might consider selling such currency pairs. However, it's essential to remember that these signals are not the be-all and end-all. They are just one piece of the puzzle. Other factors such as geopolitical events, economic news, and market sentiment can also significantly affect currency values. Therefore, it's crucial to consider these signals as part of a larger market analysis strategy. In addition, you should always ensure that each trade aligns with your overall trading strategy and risk tolerance. Never risk more than you can afford to lose, and always have a plan for both best-case and worst-case scenarios. With careful analysis and application of these signals, you can make informed trading decisions. But remember, successful trading also requires sound risk management strategies. So, keep honing your skills, stay informed, and keep your trading strategies flexible. Happy trading! Risk management is a critical component in Forex trading, but what does it involve? Let's set the stage. Imagine you're a tightrope walker, the market volatility is the wind, and your balance pole is your risk management strategy. Without that balance pole, you're likely to tumble at the slightest gust. It's the same in Forex trading. The market can be as unpredictable as the wind, and a solid risk management strategy is what keeps you from falling. Risk management in Forex trading is all about protecting your capital from the market's unpredictability. It's about making sure that even when trades don't go your way, you're not left penniless. It's about ensuring that your losses are bearable and your gains are maximized. It's not about avoiding risks altogether, but rather about understanding and managing them. One of the most effective ways to manage risk is to set stop loss and take profit levels. A stop loss is a predetermined point at which a trade will be closed if the market moves against you. It's a safety net that ensures you don't lose more than you're willing to. On the other hand, a take profit level is a set point at which a trade will be closed if the market moves in your favor. It allows you to lock in your profits before the market turns. Setting these levels is like knowing when to step off the tightrope, whether it's because the wind is getting too strong or you've reached the other side. But remember, setting these levels isn't enough. You need to stick to them. This requires discipline and a good understanding of the market. It's also important to not risk more than a small percentage of your trading capital on any single trade. A common rule of thumb is to never risk more than 2%. Risk management isn't just a strategy, it's a mindset. It's about being prepared for the worst while hoping for the best. It's about knowing your limits and staying within them. It's about balancing risk and reward to make the most of your trades. With good risk management practices, you can protect your capital and maximize your profits. To wrap it up, Forex trading using US30 and S&P 500 signals can be a profitable venture if done correctly. We've journeyed through the vast landscape of Forex trading, understanding the significance of market signals and how they function as navigational tools in this financial wilderness. Our focus on US30 and S&P 500 signals has shown us how these particular indexes can help us make informed decisions in our trades. We've seen how they can be interpreted and applied strategically to potentially maximize profits. Furthermore, we dove into the critical realm of risk management. We've emphasized the importance of setting stop-loss orders, limiting leverage, and diversifying our portfolio, all with the aim of mitigating risks and safeguarding our investments. Forex trading is not a get-rich-quick scheme, but rather a long-term commitment that requires continuous learning and adapting. Remember, Forex trading requires patience, discipline, and continuous learning. Happy trading!